Hi, my name is Jim Hilborn,
And I'm Tom Dinas.
and we are the Small Business Doctors.
And I've been taking care of business every day. Taking care of business every way. I've been taking care of business. It's all mine. Taking care of business and working overtime.
And we're going to do another show, and we're going to do a show that's the preparing your records for taxes, or just
and-
generally for the your tax professional.
Actually, both. I mean, the process is going to be the same. My goal here is I feel that if you don't fall asleep, I've done a good job.
Okay.
So,
All right.
I have to pick up the pace here and kind of, I don't know how I'm going to make this one
Well-
humorous or interesting, but we're going to go. It's pretty, a little dry.
Well, I say if you can't laugh at bookkeeping and tax preparation, you know, I mean,
yeah, you're a hard case.
you know, exactly. So let's do a little mission statement. I'm an attorney. I've been an attorney for 30-something years. My cohort here, Tom Dinas, is a financial consultant and a tax expert, has been one for 30-something years.
Well,
And we are here because we believe that small businesses are the backbone of America. And we got the idea and the impetus for this show because we both seen a lot of people over the years, including ourselves, make some very silly but fundamental errors in small businesses that have hurt them. And we decided to put together an educational series to try to shortcut through all this stuff, let you know the business part of business, because I know what you're doing if you're in small business is you're out there and you're running a plumbing business, or you're running a retail store, or you're running this or you're running that, and you don't, what you really want to know is, and what you really like to do is you like to sell stuff, or you like to do plumbing, and the business end of it is something you got to do to be successful. And so we're going to try to give you the shorthand method of that, and hopefully keep you from making any mistakes, because
we can't get you out once you're in.
we can only keep you from getting into them. That's right. That's right.
So that's our mantra.
That's it.
So, and tonight we're going to discuss about preparing your records for either yourself or your tax professional. And and somebody said, well, why do we want to go through all this trouble? My experience has been people who do not keep good records will start making estimates, and they err on the lesser.
Right.
And they leave. I believe they're leaving a lot of money on the table. Also, if you do get audited and you can't reconstruct, you may have certain deductions disallowed. There aren't a whole lot of audits, but when you do have one, they really hold your feet to the fire. I mean, they're not horrible, and they're not going to chain you up and whip you while you're going through it. That they ended that in the '86 Tax Act. They don't do that anymore.
Oh, good.
So,
good.
yeah.
I thought I was
So
gonna say they used to
basically-
do that, didn't they?
Yeah. But anyway, now it's more civil. But if you don't have good records, if you don't have the backup, you're going to lose some of the deductions, pure and simple.
Well, see, I only know about two things about tax law, but one of the things I do know is that the burden of proof is on the taxpayer to provide the record supporting each and every one of his deductions.
That's right. And as an attorney, I think you would think it'd be the other way. The
would.
burden of proof falls on the accuser.
The proponent of a fact. That's right. Not so, amigo.
Yes, I've learned that the hard way over the years. So, how do you go about it? One, you can't go on April 13th and start digging through your chest of drawers and, going out to the car and getting those, slips that then falling on the floor and
Right,
got footprints
underneath
on it
the
and
front
stuff.
seat. That's
yeah.
where I keep my records.
Yeah, it just doesn't work that way. So there's a couple simple things you can do to make it a lot easier. One, in this day and age where everybody has credit cards and debit cards,
Right.
I would isolate a card for tax deductible items. Now we're going to start with individuals first, and then we'll go on and do a little bit about businesses too. But everybody should, that's an easy way to do it. You have a debit card, and the only thing you can use it for is those. So every time you have a medical expense, or every time you make a property tax payment, or just about anything, you just do it on that card.
Yeah.
So then you have an automatic one, and at the end, and some of these even have year-end summaries for you. So it's all there. And the other thing is, and it's like my mother's old system, envelope system. She always, every payday, she put a couple dollars in this envelope, that. But if we have one place that you keep your stuff, no matter what it is, it could be a dresser drawer or a file cabinet, just one spot so that you take everything and put it there. It's all isolated, and then at year end, you can start putting it together.
Right.
And the better your records, the more aggressive you can be in the preparation of a tax return.
I was going to say that's part of that's part of our little mantra here is really keeping the records and being aggressive with your taxes because you can support them.
That's right.
Yeah.
And and with good records, I've had clients say, well, I don't want to take that because I might get audited. I don't care if you get audited. You have good records, audit's not a problem.
No.
Because we'll be in and out of that audit, in an hour.
Right.
You got a mileage log because you had mileage auto expenses, and you have a mileage log, and you give it to them. Okay, you're good.
You're good.
You've got the receipts for everything. You've got copies of the charitable contributions and the receipts. There's and we'll go into the stuff in a little bit more detail. Then claim it. Never back off a deduction because you think it might get you audited, unless you've got some strange things going on there, and we don't deal with that kind of person anyway because
No.
Jim might see them later on in their career, but
Probably not, but I don't do that much of that kind of stuff anymore. But no, we want to keep you out of trouble, and we want, but at the same time, we want you to take advantage of
everything you do.
every single day.
Right.
We want you to keep your money
Right.
because that's what we believe. It's your money.
Okay, and now one of the first places to start, when we come into tax season, is either set an appointment with your professional or set a deadline for yourself. Very, very few people work well without a deadline.
Right.
Okay, if you're working with a professional, pick a date and try to get in on a date that's to your advantage. Now, when I say to your advantage, there's a couple things at play here. One is if you think you're going to get a refund, you get in as soon as you can, because you want to
Sure.
you want to get that and get it filed and get your money back as quick as possible.
Exactly.
You're not going to give an interest-free loan to the government.
That's right.
Right. If you owe, you might want to skirt towards the end, or even if you get in early, I tell my clients you don't file it until April 15th, because then the check doesn't clear until about the 20th. So you get to use that money for a little extra time.
Right.
So.
Or if you need a little extra time to put it together, you'll have that.
And then there's this dirty little secret in my profession.
Oops.
Don't tell anybody. But we have to do about 50 to 60% of our work in little over 2 months, less than 2.5 months.
Right.
So this requires 10, 12, sometimes 15-hour days. I can't do that anymore, but I do still work 6 and 7 days a week during tax season. So if you have a complex return, you may want to get in there earlier when we're a little sharper.
Exactly. Where everybody's exhausted.
Yeah. Or if you have something you want to push hard, you sometimes get them when they're on the ropes and they're wearing down towards the end of the season. Okay. Because it's like having a 2-year-old. After we've said no 300 times, finally we go, okay, we'll try
it. If it makes you happy, yeah.
We'll give it a shot. They're not going to do anything that's illegal, but there are some areas that that could be a little gray. Okay.
That's right.
And so some preparers, they draw the line immediately. I'm personally a very strong client advocate, and I'll try to do whatever I can for the client. But there's some where I've seen returns that I go, no, I would have taken that deduction.
Exactly.
Especially if you have the good records too.
If you got the
If you
records.
don't have records, then it's okay. We're going to look at that one real hard. But if you've got good records, even some of the gray areas, if we can make a logical case, if I can look at the code or the regs and say, okay, that's, when I read that sentence, I see this, and so as long as I'm basing it on good solid facts, we'll go for it. Mm-hmm. But maybe early in the year I go, well, no, but towards the end of the season, I get worn down. Sometimes after tax season, I look at some of the stuff I did during the year and I go, what in the heck was I thinking? So, it just comes with the territory.
That's another point too, is that with good records, you can choose a little more aggressive tax preparer
Oh, yeah.
with good records, and nobody's going to do anything that's illegal. It's just like you said, the gray areas.
Right.
You know, where it's not. Depending on how you read it, there's no law that's been decided one way or the other. It's just kind of wait. And so, and if you are more aggressive and you get audited, and you have a reason that you took this deduction, the worst they're going to do is disallow the deduction.
Pay the tax, and you'll have to pay some interest. But,
Yeah.
you know, hey,
Tax and interest, no penalties though.
some depends. I mean, if it's a gross understatement of income.
Yeah,
I mean,
yeah,
there's levels of risk
But I'm
here.
just talking
too.
about
Yeah.
a deduction that could go either way. And, you know, you're just in good faith. You took the deduction. They're disallowing it.
You know, and my clients say, well, what are my, possibilities of getting audited? And I said, well, it's probably, it's less than 3%.
Yeah.
And then depending on the type of deduction, there's certain things at the first level of audit that, might go through quite smoothly for the most part. So, you play the odds, if you're a gambler, But once
Level of
again,
income has something to do with it.
actually, the highest risk audit I have seen in the last 20 years is a Schedule C loss, which is self-employment loss
Self-employment.
with large wage income. That probably has the highest audit risk of anything I've dealt
So
with
if you
over the
made
years.
$1 million and you spent $1,003, then they're going to say,
Well, no,
you
it's
know.
more like you've made $250,000 in wages, and you've got this furniture shop that you set up with all this really great, equipment that you bought, or the photography business that you set up with all this great camera equipment, or one of my favorites was the fishing guide business with the boat. And actually, I won that one.
Whoa, you're getting close to home now.
But yeah, those are the type things that they're looking for. It's a disguise, what they call the hobby loss.
Yeah, hobby loss, yeah. Yeah.
And what you're doing is you're trying to finance your hobby through tax savings.
Right.
So, and they don't like that.
No.
And so there's a whole special line of hobby loss regulations. If you're bordering on that, once again, that's one of the areas you need to have somebody who really knows what they're doing, because it can be very costly for you if you don't play it right.
Yeah.
Because they can go in and say, this is a hobby, and you've been taking $20,000 a year worth of losses, so that's $6,000 of tax savings, and we're going to go back 3 years, so that's $18,000 in taxes, plus penalties and interest. You're probably up at about $22,000
Yeah.
in tax
Yeah.
owing.
Yeah.
And then whatever the state is going to chip in at.
And then the state comes in for their 9% plus
Yeah,
whatever.
and most of the states and the federal government, I'm sorry to say, have reciprocity agreements now.
Oh, yes.
If the feds audit you and they find something, they dump the information to the state, usually 2 years down the road or so, and same with the state to the feds. So, it's one of those things you have to stay proactive, and if you get an audit at one, you need to amend the other entity as soon as possible to get
Yeah.
that straightened out. So,
Well, I think that's evil.
it's no fair.
Well,
It's
they
no
didn't used
fair.
to do that, but now they
Oh
do.
no! I now even like the federal and the states will take the other's refund. So well, you have a federal tax lien against you, and so we sent that state refund to the federal government
Yeah.
for you.
Yeah,
So
like it's any of their business. Yeah,
that one just really still
Exactly.
and the federal government and the state will take back child support out of a refund.
Oh, I knew that. Yeah,
Yeah, and
absolutely. So,
that happens quite often.
yeah,
And some people say, well, what can I do? You can't stop it when they do it, but you can adjust your withholdings so that you don't get a refund. Don't forget, when you sign that W-4, all you have to do is at the end of the year kind of be breaking even.
right.
And so then it kind of eliminates that problem. And
Yeah.
then there's also a thing called injured spouse relief, but that's going beyond the scope
Yeah,
of this one.
that's
So
yeah. We'll
you got that problem. You need somebody
need some
on your
professional.
team.
There is a way
Right.
to get professional help for that.
Yeah. So now let's see. So we're getting ready, and so we have to accumulate first of all, we start on our income item. Of course, the most common, not everybody, but a lot of people have a W-2 or multiple
Right.
W-2s. So you want to get those. A lot of those aren't being issued paper-wise anymore. So you have to go online and print off a copy for yourself. I don't know what people without computers are going to be doing, but I mean, I think it's another thing where, the these laws are coming into place based on some pretty faulty assumptions that everybody has a computer.
I think so too. I think so too. And
I don't like. So anyway, you have, and once again, the one place. Don't put it in one, or put it in your purse, or put it in your back wallet, pocket, or whatever. One place you bring and put all those things. Okay. Another thing, banks and credit unions are going to issue you 1099s on your interest income. Don't
Right.
see a whole lot of it anymore. People have spent down so much over the years, and it's just we have a horrible savings rate in this
And
country.
if you're in small business, anybody that did more than X amount of dollars with you is going to issue you a 1099.
Well, in the business, we'll get
Yeah,
to that one
yeah.
too. Yeah, that's a different type of 1099. And then you'll get a 1099 if you have money invested in a brokerage account.
Okay.
Dividends, stock transactions. Now the problem with this, the government has pushed more and more work into more compressed time frames for us. So the brokerage firms have a real problem. They get this information, they have to issue them by a certain date. And I think it's somewhere in February now. It's changed a little bit. But they never have all the information necessary to do it correctly, but they have to issue it anyway. So what'll happen then is you'll have that brokerage statement, and a couple weeks later, maybe 3 weeks later, you'll get a corrected one. So if you rush into your preparer, you rush and prepare your return and prepare it, you get a corrected one, you may have to go back and amend the returns.
Ouch.
Yeah, and it could go either up or down, but it's a lot more, and amended returns they're not easy returns to prepare. They're a real pain in the tuchus. And so you have to deal with it, and and I do them, of course, for a living, so it's not so bad for me. But if first time you ever encounter one, it's very anti-intuitive. You like kind of look and go, this does not make sense. So anyway, so you have to make sure that you have this stuff accumulated and that you're going to use the right one.
So red flag on the brokerage 1099.
Yeah, I'm
you might
afraid
want-
that is a problem, and I don't see any way around it. If you had unemployment, you're going to get unemployment. And some people claim their withholdings on the unemployment, so they have federal and state withholdings on it. The unemployment statement that you get, it's a 1099-G government statement. You only get maybe one copy, so you have to photocopy it, because any of these statements you get, 1099s, W-2s, 1099-Rs, which are retirement things, if it has withholdings on it, you have to include a copy of it with the return. All right. That may be changing with these digital things, but I still recommend it, and I think for quite some time. So I'm still the reluctant dragon, going into this paperless society stuff. I just can't deal with it.
Yeah. I mean, obviously there's some good things about it, but boy, it is tough.
Yeah. Okay, and then for the people on Social Security, you have to report so not the net amount. You have a gross amount. If you have the Medicare premium paid, you have to list that as a medical insurance deduction. All right.
Okay.
You have to put the gross amount. Not all of your Social Security is taxable. It depends on the rest of your income. Higher the rest of your income, the more of the Social Security is taxed. This gets to be a problem where you're having things like you have a stock sale or something during the year, something unusual.
Or maybe you're still working.
Are still working. Yeah, that's a whole nother program about
Yeah.
Social Security and the interactions in it. But say you had a stock sale, and so that added, say, $20,000 of income to you. And that in itself isn't bad because you get capital gains, but it might force maybe $10,000, $15,000 of your Social Security to be taxable all of a sudden. So there's another couple, $3,000 of tax. So all of a sudden that transaction doubles on the tax. So people who are in that position really want to be very careful in timing capital transactions like that, selling properties, selling stocks, bonds. So it's just something to keep in mind. Another income item, a very common one, is going to be the retirement income. All your
Sure.
IRAs
Sure.
and pensions are going to be coming to you on a 1099-R, which is kind of like a W-2, only it's a different flavor. And that also might have federal and state withholdings on it. So that needs to be attached to the returns that you have. So, now, all these things that we've just discussed are all magnetically reported or digitally reported to the federal government. and probably to a lot of the states now too, because I'm starting to see more state letters. Before it used to be all federal. And after the tax season's over, the IRS computers just churn 24/7,
Sure.
matching all those documents to your return to see if you reported it. So if you didn't put that on your return, 2 years down the road, you're going to get a letter saying, "Hey, this wasn't reported," and that's another 8,000 of income. That would have been 3,000 in tax. We're now 2 years down the road because that's kind of the lag period of time, and there'll be another $1,500 in interest and penalties. So all of a sudden, it becomes a very costly mistake.
Exactly.
All right. Now, the other one that I'm seeing more and more, as the Native Americans are buying back our country through gambling
Oh, yeah,
revenues,
yeah, yeah.
are the gambling winnings and losses. Now, I have been doing tax returns now for 30 years or so.
Not a lot of winners?
Not one. One, I take that back. There was one, he went in to get lunch at a local casino, and he got there a little too early and the line wasn't open, so he went into the slot machine place, put in $5 and won $2,500. He's the only one in all this time.
Yeah, I don't know too many winners either. I mean, most people gamble. I think they gamble for fun, and they hopefully don't spend too much money on it. But
Yeah.
but the big lottery winner now, the guys that make, the ones that come away with it, they're going to have.
That's all taxable.
That's all
It's
taxable.
all sitting out there. And the thing with gambling winnings, you can deduct your gambling losses up to the extent that you have winnings. So you can zero it out. And everybody I've done stuff for, they started sending me. I had one with a box of Keno tickets like this. Had won $40,000 during the year, and we stopped counting at $40,000 in tickets.
Sure.
This is fine for people who itemize deductions, but if you don't itemize deductions, you don't get the deduction. So if you won $3,500 on a slot machine and you had $3,500 in losses, you don't itemize, you're not going to get the benefit of the $3,500 in losses. You're going to pay taxes on it. No way around it.
Yeah.
That comes as a major shock. So, well, I read you can deduct it. Well, you can, but
you
it's
have to be
part of the
long form.
itemized. Yeah, you have to be long form. So it means like a married couple, you have to have more than now about 11.4 in itemized deductions in order to get any additional benefit. So, not a good thing.
No.
And usually it happens to people who can least afford it. Now let's go into other expenses and just the usual things. Medical. You want, and that's a hard one to keep because you get insurance reimbursements, you got co-pays, and stuff goes back, and you resubmit a bill, and it comes back, and and so there's all this stuff. The bottom line is what the net expenses out of your pocket are for the year.
Right.
So, and this is one area that I really encourage the debit card or the credit card just to accumulate that information, because it's such a pain to keep track of if you have any kind of medical expenses at all. So, and then medical expenses also include prescriptions.
Okay.
Doctors, hospitals, appliances, hearing aids. And I had one client that I'd been doing a return for several years. She says, "Oh, medical, I never have enough. And too bad I can't, deduct my counseling fees, my therapy stuff." And I went, "You didn't tell me you were getting therapy."
Right.
So yeah, it's like $10,000 a year,
Oh.
So I went back and amended the last 3 years' return. That is a medical expense. Acupuncture, chiropractic, modifications of your home.
Oh, for
health purposes,
Okay,
disability,
for disabilities, that type thing. Yeah.
Yeah, and but that one's a little trickier because there's a provision that if you go through and you add, say, railings and bathroom fixtures, and it costs you $10,000 to equip the house so you can get around better,
Right.
they say you can deduct or add to your itemized deductions everything over the increase in the fair market value of your house due to those improvements. So if those improvements, if your house was worth $200,000 and after the improvements, now worth $205,000, then only $5,000 of the $10,000 of expenses will be deductible.
Interesting.
If you increase, by $10,000, then none of it's deductible. Now, a lot of the expenses aren't going to increase the fair market value of your house by, The area I see it where is the jacuzzi is a big problem for me.
Yeah. Okay, I'm with you there. I was going to say, a wheelchair ramp, that's not going to make your house more valuable.
No, it's not. No,
Yeah.
but yeah. And neither will the handrails or the bathroom fixtures.
No,
and
they're
stuff.
not cute.
Yeah.
They're not
Yeah.
cute.
No.
They fail the cuteness test
Yeah,
right there.
matter of
Yeah,
fact,
boom.
you know, a
Yeah.
young couple going, they're going to go,
Ooh.
ooh, old people lived here.
Exactly, yeah.
So anyway, and then there's, of course, the assisted care facilities or in home care people that come in. Now, if the home care people come in and they're just cleaning and cooking, it's not deductible, but, you know, if they're taking blood pressure or, you know, helping you physically around or whatever, then that's deductible.
Can
It has to be
you
health.
apportion it?
Yeah. Some
Okay,
of them,
so-
some of them have split duties. Yeah.
Okay, so yeah.
No, and then the other standard things, you know, property taxes for your house and any other property that you may own.
Right.
And you can own 20 properties and still take the property taxes on all of them. Interest, though, you can only take it on your personal residence and one other secondary
Right,
residence.
the vacation home is what we call
Yeah,
it, yeah.
and you can't, you know, and if you have that, then you can't take the timeshare ones. And, you know, I've
Right.
had some clients have 4 or 5, you know, they have another little vacation property, one on the coast, one up in the mountains, you know. You can only take 2, and you take the 2 biggest ones.
Yeah, the most.
Okay. Charitable contributions, the stuff that you make with checks, no problem. If it's over $250, you have to have a receipt from the organization for any contribution. So if you're giving $250 a month to the church, and the church gives you an end statement of $3,000, you need a receipt for each month for the $250 that you gave them.
Oh, really?
Yeah. Anytime you give $250 or more, you need a receipt for that contribution.
Okay, good.
So,
Good point.
all right?
Yeah.
And if you go in, you know, and you know, if you go to prepare, he's going to tell you, okay, how you do this. Now go back and get those, and the organization always does it because
Sure.
that's the name of the game. Without that, they're not
Oh,
going to
yeah.
get it. Non-cash contributions is something that I've been pushing my clients. You know, they come in and say, well, I gave 20 bags of clothing, you know, so they put down $150. And I said, when was the last time you were in a Goodwill store? He said, well, what do you mean? I says, you know, go in and take a look. I said, I can buy stuff cheaper on sale sometimes than I can used in the Goodwill store. And so it can add up quite quickly. If it's over $500, you have a special form you have to include with the return. And some of the stuff, as it gets more pricey, you know, like $5,000 or more, you have to get an appraisal, include that with the return, the appraisal. The old thing where get your junker car, that's gone.
Oh,
So, but
Okay.
now, and then there's some other odds and ends stuff, but that's the crux of it. All the other stuff is kind of minor compared to those. So, and then we've run out of time again.